Hi, everyone. Welcome to a new episode of Research Hours hosted by Uniswap Labs. Some opening disclaimer here. Uniswap is the largest marketplace for on-chain digital assets. The tools we create at Uniswap Labs are built on the Uniswap protocol, which is governed by an independent and decentralized community of Uni token holders, and today is the largest decentralized trading protocol. Labs is focused on building technology that enables users to swap tokens, buy NFTs, provide liquidity, and self-custody their assets with confidence. The opinions expressed during today's conversation will be ours personally and not that of the labs, and also not financial advice. We have a few guests today. We have Denning, data scientist at Flashbots, Rafi, head of growth at the Uniswap Foundation, Tarun, founder of Gauntlet Network, and Aria, founder of Gyroscope. We'll be diving into topics related to blockchain protocols, stablecoin, data anomalies, and more. And additionally, all of our guests today are council members of the upcoming conference named the Latest in DeFi Research, short name TLDR. Denning, Rafi, Tarun, and Aria, welcome.
Thanks for inviting us.
Okay, first question. Please tell us a little about yourselves, how you end up here in terms of what you're doing. And the additional question for everyone is, we have so many conferences in Web3 crypto space. Why do we need another one? What do you think sets TLDR apart from other crypto conferences? Who wants to go first?
I'll start.
Go for it.
Rafi, I'm the head of growth at Uniswap Foundation and have been working on getting TLDR off the ground, which is both this conference that will be in New York in May, but also a fellowship program. And kind of the impetus for it was we saw kind of two popular conferences, FC, Financial Cryptography, and SBC. One which is kind of switches between Europe and Latin America, and the other which traditionally has been on the West Coast in California. And neither are DeFi specific. There's always a DeFi track, but there's not like multiple nuances within that DeFi track that go really deep. And so number one, we felt like given where DeFi is and how far it's come over the past several years, there should be like a DeFi focused conference that gets deeper into the different topics within it. And number two, there's not a conference like that draws researchers around the world for DeFi in New York on the East Coast. And so those two things are kind of why we felt like it needed to exist. And then third is that for some of these conferences, they really like kind of want PhDs to be the ones who get accepted to present. And we're really excited about uncovering emerging researchers who don't necessarily need to have an academic background, might be engineers or students. So we want to offer and kind of get more people into this space outside of who's already in it.
Cool. Sorry for kind of butting in earlier, but hey, I'm Tarun. I think the most relevant thing to both this podcast as well as TLDR is, I think, 4 years ago, I wrote was a co-author on the first peer-reviewed paper about Uniswap, which, at least today is still the most cited paper. Probably will be taken over by the V3 white paper within a month or two, based on the current trajectories. But this paper of mine, called Analysis of Uniswap Markets, in 2019, we submitted it to a bunch of different places. We submitted to Stanford Blockchain Conference, which at that time was really focused on consensus mechanisms. We submitted it to FC, and it didn't get into any of those places, despite where it is now. And the most embarrassing thing was, the person who reviewed it for SBC didn't even really read the paper. They just kind of like said, this is a paper about decentralized exchanges, uninteresting from a consensus standpoint. So there was really, and still is, no real venue for DeFi research. I think in 2018, 2019, Aria and I were probably like, and Guillermo and a few other people were probably amongst the only people who really wrote anything formal about DeFi. And it was very hard to convince people it was worth it until Uniswap had enough volume, to be honest. Like conference venues, acceptance rates are correlated to trading volume, for better or worse. Academics are people too, I guess. And so in the process, I've probably written like 30 or so papers over the last few years. I've just learned that these venues are theoretically meant to cover all things within crypto. They tend to be very specialized and siloed. And finding a place and a voice for DeFi to have its own kind of research, community is sort of one of the key things I've been looking for the last 3 or 4 years. And Rafi and I spent a bunch of time talking about, what would make the DeFi research community better in February and March. And so that sort of led us to TLDR. But I think the real thing is, there's a lot of conferences that are, to be honest, if we're being totally honest, shill fests. There are a lot of conferences that are developer focused. There are a lot of conferences that are academic, but focused on base layer and non-application level things. But there's really no venue for theoretical and empirical work on application level cryptocurrency. And we hope that TLDR will be that.
Cool.
I can go next, or go ahead.
Jinx. Hi, I'm Danny. I'm data scientist with Flashbots. I started my career pretty much back in 2018 when I joined Consensus as a new grad data person. I was looking into all kinds of like industry research or like, how can we compare the decentralization of Ethereum, Bitcoin, etc. But with, with the growth of DeFi since 2020, there were more interesting data to look into. So I started digging about DEX trading, DeFi, and then I joined Xerox afterwards to learn better about DEX trading protocol products. And when we were digging into, like, say, what's a problem or like the major pain point for users trading on DEX today, slippage is one big topic. And when you dig further, you realize it's a lot of the MEV activity that's causing users pain and slippage. And that's how I kind of ended up like going to Flashbots, which is specializing research company working on like solving MEV problem. And speaking of TLDR, and I think like I've been always being the person who is like, producing some kind of data analysis, but mostly on like blog post or like at most like research forum. The best today you see from the industry will probably come from like Ethereum research forum or some academic paper that Tarun was able to write about. So I think this is a good interface for me to also like get to know more about like the research interests from academia as well. Now there are so many people looking at PBS, DEX trading, AMM. So yeah, very excited to collaborate on the topics with my fellows as well.
So I'm Araya. I started a PhD back in 2016, and shortly after that, like around the time Maker was coming out, so back in 2017 is when I got into DeFi, back before it was really called DeFi, I suppose, and wrote some of probably the first papers on stablecoins and kind of analyzing different stablecoin mechanisms and how they can fall short. These papers later like actually materialized in practice with like problems in like DAI, Terra, and Fei, and led me to want to try to design something more resilient, which is what I'm trying to focus on now with Gyroscope. And I think this fits very well into like what TLDR is aiming for too. Like basically, DeFi is a very interdisciplinary subject, which makes it really hard to place like what's the right venue for it, what's the right conference, or what's the right journal. And especially in the space of academia, where you have very, very strict segmentation of different topics and what's allowed to be like done in different topics. Another thing is it's very hard to find people who can give good guidance about like a new subject like DeFi, and a good guidance in particular about like what are good promising research directions to consider, or also like what's something interesting to try to like actually bring into practice. And this is where I'm really excited to see TLDR take up the reins.
Okay, thanks everyone. Question for Rafi. Tarun mentioned academic research interest is correlated with Uniswap volume. What do you see as the most significant predictor of change in the amount of research activity in any area? And what's your bull and bear case for TLDR to achieve some of the drivers maybe that you have in your mind when you started this effort to organize the conference?
Sure. I think like ultimately for growing volume on Uniswap is kind of directly tied to having the best price execution and having the best experience for users. And so some of the big topics that like Tarun has spent a lot of time on auctions. There are a couple fellows thinking about MEV, and LVR redistribution is also an opportunity that all like create like more space for LPs to be profitable, which increases liquidity depth, which in turn would allow for traders to continue to get better and better pricing that's more competitive with centralized exchanges. So I think like some of the topics that fellows are working on, even though they're not specifically tied for Uniswap, the big topic areas, that the outcomes of that research could be applied to Uniswap, especially if you think about the role of hooks for V4. I think it's a little bit too early for researchers to leverage hooks to implement some of the research, but that certainly could be like a next step that comes out of the fellowship program for a couple of the folks. So I'm excited to see people like kind of be in the orbit of like AMMs when maybe prior they hadn't gotten the opportunity to be as close as they are now.
Question for Tarun. What's the strongest argument that you have heard for fair transaction ordering versus auction-based ordering in a blockchain context? I know you have been a big proponent of the latter, but I wonder what's the strongest argument against you that you heard so far?
I think the strongest argument against me that I've heard is that, hey, you can find a way to raise money for a token for fair ordering. I mean, sorry, just kidding. That was more the cynical answer. The less cynical answer is like, there do exist some applications for which such types of fairness mechanisms would make sense. Unfortunately, they don't look like any of the financial applications you tend to see within most of DeFi. Now, I could see some arguments that they're like consumer apps or games where fairness makes more sense, and some of these metrics of fairness can be more objective. But I think the notion of price in a multi-venue world with many different amounts of liquidity, different products, it's very hard to have some uniform notion of fairness. And like I said, I'm much more cynical about the people who peddle it because generally it's had a reason to launch a token with it associated.
But it's just playing devil's advocate. At least you can that argument is much weaker in one pool where there's only 2 tokens, and a lot of people have been saying, oh, I can fair order a transaction specific to that pool, right? Isn't that argument still?
So there's a difference between fair ordering, attempting to do first come first serve, and a notion of a sequencing rule. The sequencing rule is some constraints on the set of a sequence of transactions that has to be enforced. This fair ordering is constructing a sequence based on some external metadata like timestamps. the problem is those are very easily manipulated. And then you also have all the classical impossibility theorems that we know and love in social choice theory. And so there's sort of this, you're stuck in a rock and a hard place about the first come, first serve aspect. But the sequencing rules can make a lot of sense. At the same time, I think you do have to always consider the fact that in a permissionless environment, there's nothing stopping someone else from making another pool of the same type somewhere else that you can route between. And the MEV between the two pools makes the overall volume between the two grow higher than either individual pool. And in that world where you have the two pools, now you start getting this fairness ambiguity almost inherently.
Question for Danny. What's the most under-discussed aspect of PBS that you have observed in data that we should pay more attention to?
Yeah, good question. Actually, I think, for example, we barely talk about, people always talk about, say, the builder's performance, like inclusion rates and which builder is growing recently. Oh, they might be really competitive because they're a searcher builder, there's a vertical integration, but people barely pay attention to relay performance, where we've seen like ultrasounds, they've been doing a lot of like improvement, including like optimistic relay and a few others. Like right now, I understand the reason why it's not very discussed is because there's no economic incentive for relay. But I believe as the proposal in the community of PBS Guild, which is to fund the independent relays coming up, relay performance will be more important, because also I believe like searcher builder or builder, they will have their preference to submit to a relay that will give them less latency and potentially to gain better output of the bidding. Another thing is we talk about like searcher builder integration. There might be builder centralization concern about PBS, but I think there's today for a smaller searcher, they potentially also is having this layer of auction between them to the bigger builder, and particularly also with searcher builder when they're submitting their bundle to be included. So if we look at the MEV stack as a supply chain, you see the auction layer between builder and validator, but barely we pay attention to. There's also a layer of searcher and builder auction, where as I heard from some other people that there might be rebating happening today, or like potentially second price auction happening or being proposed today. So that's be interesting. Another thing is I think private mempool adoption would be also an interesting thing to look at. Recently, Tony from Ethereum Foundation published this website about mempool.pics, where you can clearly see today there's like 15% of all Ethereum transactions going to private mempool rather than public mempool. And it will be interesting to dig further to see if by different application or wallets, if this movement is happening. Because from what I've seen we inside of Flashbots, because we have a private endpoint for RPC, and we talk to many collaborators and partners, and it seems like a lot of team with big distribution power are very interested into potentially guiding their flow into private mempool. So yeah.
Nice. Question for Araya. How do we get adoption of on-chain stablecoins without enshrining sort of the fiat system into it? As far as I know, DAI got a lot of adoption once USDC become eligible to be collateral. But on the other hand, when USDC depegged, you see this like collateral damage almost within DAI as well. So how do we get around that? Is there any hope?
This is a pretty deep topic, and one that needs to be talked about more in stablecoins, I think. So the first thing is that like this depends on what you want to get, I suppose, out of a stablecoin. There's always going to be trade-offs you're going to make when you're designing a stablecoin. And depending what you want, there's already like different options today, and there are other options that you can build too. Like one example, I guess, if you're really like strictly no fiat in my stablecoins, like you can look at LUSD. It has no fiat backing, but it's also not like very stable. Like it has this fundamental, but toned down, but still fundamental like deleveraging spiral problem. This is something we discovered in one of our early papers. It's basically this like short squeeze effect that can happen, which is why like the price of DAI all of a sudden spiked up to like $1.10 back in like way back in Black Thursday in 2020. And this happens because of the design of the system, and that you can't kind of like freely convert a stablecoin unit to $1's worth of assets. And as long as you don't have that, you're always going to have something like this. Maybe that's okay for you, or maybe that's not what you want. If it's not what you want, you have to kind of add something else, some other sort of structure in there, and that brings in other sorts of risk factors. And what DAI did, what you were pointing out in the original question, was basically tethering to USDC. I mean, that's one way of basically making your stablecoin convertible for something that's worth $1, at least until it's not worth $1, like happened back in this March. But you can also think of like, maybe that's not the best way of doing it. Maybe there's like a more risk-controlled, principled way of like actually having a redemption mechanism instead of just converting back to USDC, which is what kind of informed what we wanted to do with Gyroscope, which is trying to make a bit more risk-principled sort of approach to doing this sort of conversion process. But there's also other approaches too, like Rye is one that, well, hasn't really worked out so far. It involved taking on negative rates for stablecoin holders, which is basically if you're a stablecoin holder at certain times, depending on whatever the market for leverage ends up being, whether there's like a lot of demand for leverage or not a lot of demand for leverage, at certain times you can end up paying basically what you can think of as like an insurance fee or something, this sort of like negative rate on the stablecoin. This can also help you tackle the problem, but it doesn't. It presents like a pretty big hurdle to adoption. So, I mean, basically, there's a bunch of trade-offs you're gonna have to make. Right now, people seem to want to use like something that is worth $1, which is why all of these other solutions haven't really been taking off. Maybe at some point the desires of stablecoin holders will change, or maybe there's a kind of like a more natural currency that'll sort of arise in the stablecoin space. This is something I think is like underexplored overall. Like, do you have to have kind of like a static monetary policy, or can you have something that changes depending on the circumstance? Maybe. I guess the space is pretty wide open, but it's not really a solved problem.
Question for Rafi. What's our learning from studying incentive programs? I know you've funded a bunch. What worked and what did not?
Yeah, so we started looking into incentives. Currently, the foundation has earmarked $9 million to spend solely on incentives to grow volume in TBL. And so about 6 or 7 months ago, we started working with Gauntlet on saying, okay, like, what are all the different types of incentive programs we could do, ranging from trader loyalty programs to thinking about pay for order flow, developer mining concepts that Citadel and Robinhood have implemented, to liquidity mining, which is kind of tried and true in crypto. And we kind of took these different types of programs through a like math framework, and ultimately Gauntlet recommended that liquidity mining is the most capital efficient, high ROI way of thinking about incentives. So the first part of it is like defining how we compare different types of incentive programs. And so then we started on optimism. There's kind of like two mechanisms by which incentives can create this long-lasting stickiness and liquidity. Because the kind of cycle that you want is like more volume, more fees, more liquidity, more volume. And so like one of these two mechanisms is like lazy, inefficient LPs who might forget to remove their liquidity when returns drop, meaning like you add incentives to a pool. Do they just keep their liquidity there even when the incentives go away? And then the second is liquidity bootstrapping. So this is saying, okay, well, LPs only care about return. They are actively paying attention. Returns can be derived either from fees or from incentives, and fees are a function of volume, and so that you get that flywheel. And so I think we think the LPs are lazy, inefficient is not the answer. So the answer that you look for is, okay, well, if LPs come in and when there are incentives on a pool, TVL will increase and volume may correlate increase, but when the incentives go away, do you still see higher volume afterwards? And so I think one of the big learnings for me was like, the answer is like, it depends, and it depends on a lot of different factors. Number one, what's happening in the market plays a big role. Number two, it depends on what chain you're on. Right now, we're doing a series of liquidity mining, and we're looking at basically they're choosing, let's say, 10 pools where the pairs are really popular on that chain, but Uniswap v3 isn't like the market leader getting all the order flow. So that seems right now to be an effective strategy of where incentives and specifically liquidity mining is impactful, is on pools where there's like tokens that are in demand, but it's effective in having Uniswap be able to bootstrap and be able to like win orders more frequently, and that lasts afterwards. But the other kind of surprising thing is that it takes quite a bit of time and money, therefore, to kind of fine tune, because it is so kind of it really changes depending on the chain and the market dynamics going on within crypto.
Question for Danny. What are the, as you said, right now there's no incentive, or actually there is incentive, but there's no payment for people running, free infrastructure such as relays, or some of these, private RPC providers even. What's the future like for them? Because people can't run things that cost money for free forever. What do you think are the externalities right now, and how would that change in the future?
Yeah, I think, for example, like the relay case, right now there's no incentive, but as I mentioned, there might be some proposal coming from the community to incentivize them with some funding, which sounds neither like organic from the market dynamics. For private RPC, as today, like Flashbots is also running one called Flashbots Protect, where we're trying to get as much as retail flow as possible, either from from retail user who go to our documentation and add the RPC to their wallets by themselves, or by working with the wallets who can potentially direct us their buckle of flow. So I believe the typical path for these markets, which would be the same as building a protocol or application, is like to gain the adoption or gain the distribution power first. And like Uniswap, like once you are in a dominant market position, you'll potentially be able to enable your fee feature, and while still having people being pretty sticky to either UX or feature that you're providing. So I think I can see that. Another thing that I've already seen is that like there are some private RPC provider, they're already like selling their flow to other block builders, because if you imagine this stack of the supply chain, private outflow is they say kingmaker of like block building, because if the transaction is seen by less people, you can potentially keep more margin for the value they're providing to the block space. So yeah, I believe there are some sell, like one example is like I believe Maestro or like some Telegram bots are sending their flow exclusively to some private RPC provider and potentially with a deal. So yeah, I think those providers probably can potentially have a margin from the private flows value that they are acquiring from as a potential path. Yeah.
So do you think we will see further vertical integration from user all the way to on-chain?
I think that's possibly happening right now, especially if I may point it out, like Special Mechanism Group was acquired by Consensus, which has pretty big user power, and we may see a lot of the players in different layer of the stack can potentially integrate. Yeah, and also I believe like imagine the account abstraction space where they're having a similar design of like having transaction bundler, which is doing pretty much similar work as block building, who is also merging the bundles, will likely also merge into the same place with the same players potentially.
Araya, do you have a playbook for evaluating an arbitrary stablecoin? If I bring something to you, do you have a diagram of inquiries that you would follow to get a sense of how sound the design is and how stable this stablecoin is?
That's a nice question. Wish I had like a very clean diagram to show or something, but I don't. But I can kind of break it down into like the main questions I would ask first. I think the first question I'd really ask is what type of mechanism or mechanisms is the stablecoin employing here? And once you kind of get past this, it's then a lot easier to like break down like what are the different design choices and what does it mean for the stability of the stablecoin, and where it's a bit cleaner to actually like have good diagrams, I guess. So you kind of need like a couple of different diagrams. But there's like two main types of mechanisms here, and it's probably worth just like spelling them out a little bit. One is a leverage-based mechanism. And so this is a mechanism where somebody's coming to the protocol with some amount of assets, and they're essentially like borrowing stablecoins into existence by borrowing against those assets. So this was the like original DAI mechanism, also how a lot of other CDP type stablecoins work. And the other main type of mechanism is basically like a reserve-backed mechanism, or something where stablecoins are issued but backed by like a balance sheet of protocol-owned assets, basically. And these different mechanisms have very different behaviors that need to be thought about. You can also have combinations that do both of these mechanisms. So, for example, DAI is actually like still has CDPs, the back part of the DAI supply, but they also have a very significant portion that's now backed by something that is basically like a reserve-backed sort of mechanism. This is coming from like the PEG stability module and real-world assets in DAI. And once you kind of like get to this distinction, then you can kind of work out like what are the intricacies of like these different types of mechanisms. On the leverage mechanism side, you have to be a bit worried about just what are the dynamics of this leverage market? What can that mean for the stability of the stablecoin? And in particular, like we talked a little bit about deleveraging spirals before. Deleveraging spirals are something that hit the leverage side of a mechanism. And so if you only have a leverage mechanism backing your stablecoin, then you have to worry about deleveraging spirals and sort of this short squeeze effect that causes price volatility in extreme times. But if you have a combination of like the leverage mechanism and the something like a reserve-backed mechanism or something else to like help tone down these deleveraging spirals, maybe you can kind of overcome them. The next level then I'd start to think about is the type of asset backing and what this also means for the stability of these different types of mechanisms. So one key point here that like unfortunately is like a key point, I guess, is if you have like issuance proceeds of the stablecoin, like where does the issuance proceeds go? And this is where like endogenous collateral basically came up as a huge shortfall in stablecoin design, in my opinion, because if you have endogenous collateral backing the system, this is basically like something that's like an equity token almost for the protocol, and basically has value that's circular with the protocol itself. And why it's circular with the protocol,
right?
Yeah, exactly. Why it's circular with the value of the protocol is basically the protocol is directing issuance proceeds. So basically somebody comes to the protocol with like $1 worth of assets and wants to acquire a new stablecoin. They, at some point in the process, they pay $1 worth of assets for that stablecoin to somebody. And a key question is, where does that $1 worth of assets like end up? And in endogenous collateral stablecoins, it basically ends up in the pockets of people who own like the endogenous collateral, and it's not really there in the future to actually like protect or defend the stablecoin system. And so you basically end up with something that kind of resembles like a Ponzi scheme. Like new money is coming into the system, but it's like then flowing right out of the system back to like basically prior investors into the system. So pretty sketchy in my opinion, but you kind of need to think about that sort of dynamic here. It's one of the key things I think about for like asset backing. But there's also like other components to asset backing too. Once you've gotten past that sort of like basically unbacked endogenous collateral sort of idea, and you end up with like kind of like actual assets backing the system. Of course, different assets have very different risk profiles, and you have to consider if you're holding those assets or if the protocol is like exposed to these different assets, whether it's as like a collateral asset for lending or whether it's like a reserve asset, like directly backing the issued stablecoins. You have to think about how likely is this to cause like a shortfall for the actual stablecoin system, and how likely would the stablecoin system be able to recover from such a shortfall? And so evaluating the risks of the different assets is pretty key there. There's also a lot of other components. Maybe I'll just mention them, but not like kind of get into details here. But of course, like Oracle choice is like pretty important, and the resilience of your Oracle choice. This was another thing that kind of plagued a lot of stablecoins, surprisingly, back in March when USDC depegged, and a lot of stablecoins got caught basically having a hard-coded Oracle for USDC is worth $1, and then all of a sudden USDC is not worth $1, and all the infrastructure breaks. Like ideally, you have something that handles at least that, and is even more resilient to kind of like Oracle mispricings. And also the quality of your governance system. You want to set up a system ideally in DeFi that has the incentives set up right, basically to be able to govern itself. If the contracts are upgradable, that means somebody has the power to like potentially rug the system or potentially like extract value in other ways from like maybe making good or maybe not good choices. Like ideally, you don't want them to make not good choices about upgrading the system. And governance is a pretty wide open topic about like how do you design it in a way that like gets you the best incentives, gets you the best state of DeFi that we're all aiming for. This is actually one of the topics of the TLDR supporting this time around.
Question for Rafi. From your experience funding research, and a lot of these funding mechanisms are basically grants, right? Which funding goes out to the researcher, and you're sort of counting on their goodwill to complete the project in a quality manner. What are the mechanisms that you find to be most effective in terms of holding people accountable and incentivizing people to do their research unconditional on receiving the funding because they pretty much already have gotten it?
Yeah, I think one big piece is around diligence. So before you select, like the way you select someone, that's something that Danning, Arya, and I, and the rest of the council did quite a bit of like training around, is like, how do you choose 107 people who are really great applicants applied for a 10 slot fellowship program? And how do you choose? And so I think there's so much around diligence and how someone creates their proposal and demonstrates that they'll be able to complete it on their own. You can also look at their track record, and I encourage the council to also have at least one phone call with their candidate fellow, so that when you go into the program, you've already kind of like de-risked that quite a bit. And it's less about like, it's especially for research, it's more just like, can they complete this on their to some extent on their own? Have they done that before? Do they have the experience and the skills they need in order to answer the question that they've proposed they'd like to answer? So I think that's a big piece of it. And then the other is onboarding. So I met for one-on-one with every single fellow and made it like a 10-page onboarding document with like a template on how to prepare your research. Like by this date, you meet with your mentor. So we've really tried to like upfront, like de-risk a lot of it to set everyone up for success. And then I think like researchers are inherently motivated by being published, having their work out. So it's more for us to just like unblock and make sure that they have the resources that they need.
Danning, what are the positive and negative externalities of builder latency games? And more importantly, how do we tell? Because there is no counterfactual There's no Ethereum without the latency game. How do you test your conclusion?
Yeah, to the first part of the question, what are the positive and negative externality of latency game? If I think about each role or player in this whole game, if we talk about like builder first, it sounds like the whole reason you would want to compete with a latency game is you don't want to post your bid too early and then introduce competition. If say someone else who has bigger flow or a higher value that they can bid for will outcompete your and land their the final block and include their own transactions across platform, like say CeFi, DeFi arbitrage as well. So sounds like the latency game, meaning like the later you bid, the better your outcome will be. Seems positive for builder. But then if we think further about like who are able to really compete the latency game today across the builders, really is just the searcher builder who are also having like a better infrastructure setup, who are able to adjust their bid within 200 millisecond, 100 millisecond. Most of the other builders today who are more naive and just neutral builder will likely be having a higher latency, so pretty much get invalidated or failed out of the game. So it's positive for those searcher builder, but negative for other builders who have less edge on latency, which overall I believe is pretty negative because it's pretty much encouraging the centralization of bigger builder as well. And if you think about the smaller builder, it will also affect the retail flow, or like say the user from the RPC end. Like if say, for example, today I'm using Flashbots Protect RPC and sending my transaction to Flashbots Builder, but Flashbots Builder is not able to compete with other big searcher builder, then the user's transaction may get stuck in my bundle as an exclusive order flow of mine as a Flashbots builder. And then user just gonna wait there for 25 blocks. Maybe Flashbots builder cannot really win any block, and now user gonna have to resubmit. Or it will be a really bad experience for the RPC user. And speaking of validators profits, because latency will give builder bigger profits or margin, like they are able to give less margin profits out to validator, I assume the latency would also likely reduce or maybe decrease the profits or revenue for validators, which I think is not a bad thing, because today over 99% value is going to validator, which is also a question some people ask, say, oh, if it's today is a validator monopoly. So yeah, overall, I believe, generally, how can we benchmark or compare a protocol design when there is no alternative? One thing we did was looking just historically before and after the merge. We saw that like there was a data showing that before the merge, on-chain atomic searcher were giving out much less profit, which is around maybe 50% or slightly below 50% profits. But after the merge, because everything on chain is indexable and like a lot of people are competing, the atomic searcher are giving out like over 90% profits towards validator. So so to answer the question, one way to look at it could be before and after at the launch. Another thing, example would be like, for example, a question we encounter is usually how can we measure the execution quality for private liquidity across DEX trading platform? I believe that's probably also a question for Uniswap today that Xing, you might be also working on. Like, for example, if you say we have different market maker providing quotes for DEX traders, how can we know they are giving us the best quote when we don't know their other side of trade on centralized exchange? One way we did back in 0x is really just to benchmark based on, if without this component, what's the best we can get? So meaning compare them with the best accessible or optimal AMM liquidity in the market, and then compare how much execution quality improvement they can bring, price improvement they can bring. So yeah, that would be another answer.
So it sounds like you're saying latency games sort of reduced margin for atomic searchers. Is that the
That will be a separate point. I would say latency game probably is letting builder to be able to keep more profits, especially searcher builders. The other searcher giving more profits out after the merge is I don't think directly related to latency, but more just like a interesting behavior after the merge when which I believe is as designed because MEV-boost is aimed to like have all the bits transparent through like relay data API. So that's why like every bit is on chain, not on chain. Sorry. I mean, Atomic would be on chain. Everything is transparent with data traceable, and that's probably one reason why they are giving out less, keeping less profits.
Yeah, I guess I just wonder, if it's just wealth transfer between these searcher builders, then it's not really externality. And I was wondering if we would expect something like faster transaction inclusion or slower transaction inclusion on behalf of everyday users who is just sending sort of transactions without MEV or with very small amount of MEV. Do you think these latency games are making their lives harder or making their lives easier?
Yeah, I think the builder latency is really discussing about the last, say, 2 seconds of the 12 slot. So probably wouldn't affect users' inclusion time directly compared to like how end user is deciding when they're going to submit their transaction. But one point I mentioned just now, I think is a negative externality for user is that when smaller builder who don't have the centralized exchange flow, meaning they're not a searcher builder, but they do have their private order flow coming from their RPC product, like for example, Flashbots builder. In this case, we're not able to compete as the best performer in the latency game, then our users' inclusion rate will be slower if we can't land a block within a few blocks time. So yeah, it will be pretty negative for end user who are using RPC product that's from a smaller builder.
Araya, question on stablecoins. So it looks like you're pretty bullish on these multi-asset reserve stablecoins, such as Gyroscope, if I'm understanding correctly. But if it's multi-asset, then technically it should be able to be pegged to any currency, right? Or that would almost be the ideal case when you have sort of less, well, maybe not ideal, but you do have sort of the not one correlation between all of your assets, and you're trying to make it hedged. What makes one currency easier to peg to from a stablecoin design point of view than others? Is it mainly a liquidity problem on this particular currency? Is it an Oracle problem where it's easy to tell how much this currency is actually worth compared to other assets you have? Or is there something else?
Yeah, this is a pretty interesting question. I think I would break it into a few different things to think about. And first, it's probably worth like reflecting on like how do currency pegs work and like when can they break? Because this is kind of like a key component of this, of course. And basically, the only currency peg that is like assured is basically where you have 100% backing in the asset that like you're pegging to. And if you don't have this, there's always some settings where the currency peg like can break, whether it's some sort of shock to underlying assets, or whether it's kind of like a run on the currency, or depending on the actual setup of this currency peg design. But if you don't have that kind of like 100% backing, which is kind of like the 100% backing of the like asset you're pegging to, which is kind of like the trivial thing, or most likely like look something like USDC basically. If you don't have that, which is what decentralized stablecoins are aiming to hold, because like a decentralized stablecoin can't hold USD directly because it doesn't exist on chain, can't really hold it in a decentralized way. You're going to have some problems. And then in terms of like what currency is easy to peg to versus which one is hard to peg to, well, it depends on kind of like what your mechanism design space looks like. And a key component of that, I guess, is which assets like you actually have to work with on chain. Like if you're trying to peg to USD and you have a bunch of like centralized USD stablecoins, it's like fairly easy to maintain a peg, and this is what DAI found. But if you're trying to peg to some obscure currency where there's no like centralized stablecoin that exists for it, you're basically you don't have kind of like a default asset that you could have in reserves to like always make redeemable for a stablecoin, which means that like you have to back with something that isn't like denominated in that unit, is going to be kind of volatile compared to the currency you're trying to peg to, and like that just makes it like pretty probable that you're going to end up in a situation where you're underbacked at some point because prices moved in a certain way, and then you can't sort of like sustain redemptions for the whole stablecoin supply. And that means that like at some point the peg is unsustainable. It may not be unsustainable right away. It really depends on like the dynamics of the system and how much of an economy you've built around this system. Like, of course, real currencies aren't like 100% backed in assets all the time, but they still function. And this depends on kind of what's actually like guiding these currencies in terms of like monetary policy, as well as like what sort of strengths the government has and what sort of economy this having access to this currency unlocks. And you could have a stablecoin that like develops some of these characteristics. None of them right now do, but they could also kind of like help strengthen a currency peg, even to like an obscure currency, if that's what was for some reason desired. Another component is if you're kind of basing this on like a leverage mechanism, so you're making kind of like a synthetic currency where people are kind of like borrowing this asset against other collaterals, but they're kind of like choosing to denominate it in whatever obscure currency. The sustainability of this depends on who wants to borrow this. Basically, this is kind of like one of the criticisms of trying to make like a stablecoin that's like pegged to the like consumer price index or something that like increases over time. If you're trying to secure the mechanism using a leverage mechanism where somebody has to borrow this into existence, if it's supposed to like appreciate in value over time, like, well, it's much less attractive to borrow it and try to leverage by borrowing it. So all of these kind of contribute to like what is actually maintainable in terms of different currency pegs. It gets pretty complicated, and this is kind of why like the stablecoin design space is pretty wide and kind of needs improvements.
Cool. So Rafi and Tarun had to drop early due to other engagements, but last question for the two of you. What is the research area outside of your own work that you're most excited about right now?
I think there are some effort from either the data side or from, like, say, ZK community to potentially have some protocol to prove humanity, or like basically index if it's a real one person behind one wallet, like either from WorldCoin using like a whole ZK protocol, or from like say Spindle, which is like a data attribution company where they're trying to link the step for a user entering the deck trade interface before and after, so to be able to attribute, say, hey, this much volume from Uniswap website is coming from CoinGecko or coming from somewhere else. Would be interesting, because I think that's always been a pain point for Web3 data analysis compared to Web2 analysis, because Web3 has its special attributes where it's anonymous and we don't know how many identity are behind one wallet, or how many wallets one identity control. And with those kind of linking would be very helpful for us to have more clarity of like lot of questions, say like be able to identify wash trading or be able to identify the cost of a customer, if it's reasonable or not, and design better potentially token distribution. I'm not saying airdrop, but better distribution based on user behavior and their like lifetime value towards the protocol, etc.
I think I would choose kind of like off-chain co-processors, things like ZK co-processors, kind of for the selfish reason of like, I wish there was easier way to like access a lot of things on chain in a trustless way, and this seems like the most promising way to be able to unlock some more capabilities there. But things like, I'm pretty excited about things like Axiom, where you can take stuff that you can read about chain state, but can't necessarily like manipulate directly on chain, or maybe it's too costly gas wise to like do it on chain. You can take that, do some computation off chain, and then prove that the computation was done correctly against the chain state you can actually observe through like the EVM, and then be able to do like a lot of things you wouldn't be able to do otherwise. One pretty exciting thing, I guess, is like improving like the capability of like Oracle systems, I suppose. Like there's a lot of things, but this is also where it's pretty selfish, because like this is something we're trying to do. We have like an Oracle system that tries to aggregate a bunch of different like sources of information and try to tell you like how likely is the centralized Oracle price, the one that's like fast and like can respond quickly. How likely is it to actually be correct, or how likely is it to be wrong, and then basically like unlock the capability for protocols to make more informed like internal choices of, should I trust this price 100%, or should I discount this price, or treat it somehow differently? And there's some things you can do for that now, but I wish there were a whole lot more you could do, which I think something like an off-chain coprocessor would help to unlock.
My understanding is something like Axiom allows you to sort of unlock the compute complexity constraint, but not necessarily if you want to access off-chain data, right? Because you need to verify sort of the source of the compute, and then you can trust the ZK to prove that the compute was done correctly. But suppose you're trying to access price of a vague currency that's backing something on chain, you still wouldn't be able to do it. But isn't that the most sort of pain point right now, or is actually compute that's the main constraint?
I think there's a bunch of like kind of Oracle problems here. One is a fundamental Oracle problem you can't really like completely solve, and that's of course if you, and it's especially relevant for a stablecoin, if you're pegging to $1 or a euro or whatever, but something that exists off chain, you have to have some sort of Oracle that tells you that brings that data on chain. You can't get around that. So these coprocessors aren't really going to help directly with that. But there's a lot of stuff that happens natively on chain that basically embeds some of this information. So like different markets that happen on chain, that where actors in those markets know this price and they make decisions having known that price, and you can observe like the decisions that they made, the actions that they took, and this can help you inform about like what was the likely price actually at this time. And so I think there's like some room to like do some manipulation of some on-chain data, like use on-chain data to kind of inform about some extra price information that just helps you get some extra guarantees, even if you like still fundamentally need an Oracle to like give you information bring in information from off-chain. You can kind of think of it as like adding some extra like sense checks on top of it.
Danny, Araya, thank you guys very much for coming on. It's great to have you guys.
Thanks for having us.
Thanks for the time. Thank you.
Take care. Bye guys.